There are two REITs on the Singapore Exchange that invest in healthcare-related assets, Parkway Life REIT and First REIT. Interest in these REITs are rising due to an aging population, which increases the demand for hospitals and nursing homes, both of which these REITs invest in. Today, my focus is on Parkway Life REIT. In this video presentation, I will be covering the essentials you need to know about its property investments, financial performance, portfolio occupancy, debt profile, and distribution payouts over the last 5 years. Additionally, I will be sharing my technical analysis of Parkway Life REIT's recent unit price movements on a weekly time frame, highlighting key price levels and their corresponding distribution yields based on the latest full-year distribution payout. Let's get started. A brief introduction about Parkway Life REIT for those of you who may be unfamiliar with it. It is currently one of the largest listed healthcare REITs in Asia with a portfolio size of 2.23 billion Singapore dollars as at the end of the latest financial year on 31st December 2023. In terms of properties, it has 3 in Singapore, and they are the private hospitals in Mount Elizabeth Hospital, Gleneagles Hospital, and Parkway East Hospital. 59 of its properties are in Japan, which are nursing homes, as well as one medical center in Malaysia, which is MOB Specialist Clinics in Kuala Lumpur. Looking at revenue contributions by geographical locations, the 3 private hospitals in Singapore contribute 67.6% towards its gross revenue in the financial year 2023, and the 59 nursing homes in Japan contributing 32.2%. Now, let us take a look at Parkway Life REIT's financial performance and distribution payout over the last 5 years, between the financial years 2019 and 2023. Except for the financial year 2021, when Parkway Life REIT's gross revenue and net property income slightly declined due to the divestment of a non-core property in Japan in January 2021 and the depreciation of the Japanese yen, the remaining 4 years experienced year-on-year growth in gross revenue and net property income. However, the REIT's distributable income to unit holders and distribution per unit saw improvements every single year. The compound annual growth rate of Parkway Life REIT's gross revenue and net property income over the last 5 years was approximately 5.1%. Meanwhile, its distributable income to unit holders and distribution per unit grew at about 2.3%, which I consider to be a respectable growth rate. Finally, one thing to note about its distribution payout frequency. Since the financial year 2022, the healthcare REIT has changed its payout frequency from once every quarterly to once every half yearly. Parkway Life REIT's portfolio occupancy rate have remained at a stable level of 99.7% throughout the entire 5-year period I have looked at. This high occupancy rate places it among the top performing REITs listed in Singapore. Another thing to highlight is the huge jump in the portfolio weighted lease expiry, or WALE for short, in the financial year 2021, which was due to the master lease renewals for its 3 Singapore hospitals for slightly over 20 years until December 2042, with a 10-year extension option. Moving on to the healthcare REIT's debt profile, Parkway Life REIT stands out among all the Singapore-listed REITs with one of the healthiest debt profiles. This can be attributed to its low aggregate leverage and all-in cost of debt, coupled with a high interest coverage ratio. However, recent developments in Japan, particularly the end of the era of negative interest rates by the Bank of Japan in March 2024, have raised uncertainties. The timing and extent of future interest rate hikes remain uncertain. In my view, any forthcoming interest rate increases could adversely affect the REIT, potentially increasing its borrowing costs and impacting distribution payouts to some degree. This is something investors should consider. Here's the unit price movement of Parkway Life REIT on a weekly time frame since January 2022. As you can see, since its unit price hit a high of 522 then, it has been on a downward moving trend. Its unit price has been moving in a range of between 342 and 367 since the end of October 2023. You will also find the respective yields for the two prices based on its full-year distribution payout of 14.77 Singapore cents in the financial year 2023. At 342, which is the lower end of the range, its yield is just 4.3%, and it may not appeal to some retail investors. Of course, that's my personal opinion. To sum up, Parkway Life REIT is in the defensive healthcare sector, where properties in its portfolio comprises of hospitals in Singapore and nursing homes in Japan. Demand for its assets is expected to remain high due to aging populations in both countries. Financial performance and distribution payout over the last 5 years has been stable. At the same time, its portfolio occupancy has been maintained at a very healthy rate of close to 100%, and debt profile being one of the healthiest among the Singapore-listed REITs. However, one concern will be the impact to its distribution payout when the Bank of Japan starts hiking interest rates. With that, I have come to the end of my sharing of Parkway Life REIT. I hope the video presentation has given you a good understanding about the healthcare REIT. If you find it useful, I would greatly appreciate it if you could give this video a like. Also, if there are any REITs you'd like me to do a similar presentation on, please let me know in the comments section below. Thank you for watching, and I look forward to talking to you again in the next video.